Hi everyone, I'm Chad Shoop and welcome to this week's edition of my weekly options corner. We're doing a little bit different because I wanted to cover some of the recent questions that have come in because I thought these topics were very broad and they would be great for everyone to see my responses to these questions, so that way we can all have the same takeaways and the same general understanding for options and how we can move forward and continue to find profitable trades. Now, last week we broke down what a profitable trade looked like. We did a case study on the Facebook gain. But in the coming weeks, we are getting into the heart of earnings season, and I plan on being able to kind of show you alongside us when we actually have one of these trades get triggered and we're jumping into these after they hit my profit trigger, that I can share that with you and we can break down everything that I'm looking at in this trade, why we got the price we did, why we picked the option we did, and just kind of walk through everything in almost real time so that way you can see how these trades are setting up and maybe jump in and be able to profit on your own from these trades that we use around this earnings season, for that I use for my quick hit profits strategy. So be on the lookout for that in the coming weeks. But again, today we wanted to do this little video mailbag so that way we can cover some general questions that have been coming in lately. So we're going to dive right into this week. And our first question, it's a general one that I wanted to feature because I get it all the time. People, they get the trade alert and then maybe they didn't get to jump in right away and they're worried that they missed out on this trade. So they want to know if the trade will still work and if it's too late to jump in. So that's our first question to tackle today. Now, I love this question because 9 times out of 10, it's still going to be okay to get in. Most of these trades do not move too fast in the first day or two. We usually have maybe 24 to 48 hours to actually get into these trades before they go above my limit price. So that's the key thing though. Whenever I send a trade alert out, I go ahead and tell you the highest price that I want to accept. That's my limit price because we don't want to move the markets. So by setting this limit price, we know that that's as much as we want to pay for this option, for this trade. And at the end of the day, if it shoots up faster than that or goes too high too fast, and then I'm willing just to walk away from a trade because I don't like chasing them, because a lot of times we'll see that big jump on the first day that we send out a trade alert. And for us, when we're jumping in based on my quick hit profit strategy, we're jumping in usually on the day of earnings that they already been announced. So there's a lot of volatility in the stock. So if we chase it that first day where the market makers are just kind of picking up prices wherever they can and they'll take bids and ask all over the place, if we don't stick to our limit orders, you can end up overpaying for the stock and then the next day see it drop dramatically 20 or 30%. And really on no news, the stock doesn't have to move much at that point either. It's just volatility in the options price. So by sticking to our limit price, we're able to get the best price possible, and it's usually good for at least a few days that we can still jump into this trade. So most of the time, no, it's not too late. We don't have to panic. But if you do miss the trade, it's not that bad because we have several trades, basically one every other week. So we're going to be able to jump into a new trade relatively fast. So you just got to hang back, and if we miss a trade one time, it just doesn't give us the price, that's fine. We'll jump into the next trade. Now, our next question comes from Doug, and he says, in general, everyone seems to always say calls are for the market going up and puts are for the market going down. I'm thinking this isn't exactly accurate. Shouldn't the generalist say when buying puts, you're betting the market goes down, instead of saying put options in general are betting the market goes down? And Doug's exactly right here, because when you talk about put options in general, we always just say put options are for when the market goes down, call options are for when the market goes up. But we're generally speaking about buying put options, about buying call options, because we talked about this the other week. When you change that and when you're selling call options and selling put options, then it changes the dynamic for that risk versus reward scenario for these options completely. It just flips them upside down. So when we're selling put options, now all of a sudden we want the market to really go up, because when we sell the put options, while we're okay and we would be excited to end up buying shares of the stock, really we just want to collect that income and continue to collect that steady stream of income. And as the stock falls, once we own it, then if it keeps falling, then we're at a loss. So we are still looking for the stock to hit higher. And the same with selling call options. That's a different risk strategy because the stock can rise to an unlimited amount. So if you sell a call option, your loss profile there is technically unlimited, and you don't want to ever have an unlimited loss situation. So I would never recommend selling naked call options, but they're great when you own the stock. You can sell a covered call and collect income, but at that point you're either agreeing to sell your stock at that strike price for the call, or you're expecting the stock to go lower, so that way you can collect the income and then continue to sell call options over and over again. So it does change the dynamic, and that's important to understand. That's why we've already covered it here in the weekly options corner, because I wanted you to know the difference between buying options and selling options. It's just a totally different dynamic that we want to kind of have ingrained. Even though maybe when you trade, you're only going to be buying options. You're only going to buy put options on a stock you expect to go lower. And you're only going to buy call options on a stock that you're expecting to go up. And you just keep it simple. But you still need to understand what it means to sell the put option and to sell the call option. Because down the road, when you have a bigger stock portfolio, those strategies and those types of ways to use options are going to become even more beneficial and help you create profits in the long run. Now, our next question is another general question that I get frequently. It's, what is the difference between a limit order and a market order? So I already mentioned that whenever I send out a trade alert, whenever I put an entry in to buy an option, even on my own brokerage account or when we send out trade alerts, I always use a good till canceled limit order. And what that means is, and we're talking about buying options here. So when I want to buy the option, let's say I want to pay $2 for this option. Currently, maybe it's trading for $2.10. That's the bid price. Maybe the ask is $2.20. So I'm looking for it to fall back a little bit to $2. That's the highest price I want to pay when I say a limit option. So now if that same option is trading at $2.10 for the bid, $2.20 for the ask. Now if we put in a market order, it's going to get filled at the ask at $2.20. So, and this is just an example. It could be a much wider spread, a much different price structure than what I'm using in this example. But using a market order there, you would pay $2.20. It would get filled right away. That's what a market order does. It guarantees that you're going to get this option filled. You're going to buy it at whatever price the market hands it to you at. And it could say $2.20, and then by the time you hit your market order in, maybe it jumps to $2.40, because once they see those market orders come flooding the market, they're going to change the price as well, because they see that you're willing to buy at any price that they give you. So they're going to bid that price up and up and up until those market orders kind of go away. So if you're using a market order, just be aware that it's usually something that's moving really fast and you just want to get in on. But those types of trades I usually avoid because I don't like to chase trades. So I always use limit orders. I'm going to sit at that $2 price and I'll sit there for a couple hours. I'll watch the market. I'll make sure that it's kind of staying around my price. And if it starts to run a little bit, then maybe I'll inch up my limit orders a little bit to buy it as soon as it takes a little bit of a dip. But the bottom line is that when I send out my recommendations, we're going to use a good till cancel limit order, which means that I want to leave this on the market for up to a week before I would even cancel it. And if it isn't filled by then, I always update our readers to let them know that it's time to cancel this order. But 9 times out of 10, we're going to be filled over that 1 week period. And it's usually filled in the first day or two, so we don't have to worry about it. But if it ever does take a few more days, then I just keep them updated on that. But that's part of being able to trade options and to trade them to create consistent profits is being patient. And we want to be patient with the price that we get to stick with the price that we want to pay for this option, because this option price is going to help dictate how much profits we actually see from this trade. Whether we pay $2 or $2.50, it's going to really, it can really alter the types of returns that we're going to see. For example, at $2, we can see a 50% gain once it hits $3. But if we rush and we put in that market order and we let the price run up a little bit and we end up paying $2.50, now we don't see a 50% gain until it hits $3.75. That's a big difference when you go from $3 to $3.75 and you're trying to see the same type of profits. So patience definitely pays off when it comes to trading options. So we're going to stick with our limit prices. I use a good till cancel so that way that shows that we have patience over the next few days. We don't have to rush this market, and I'll just keep an eye on it. So that's how we want to use the difference between limit orders and market orders when we trade options. Now our next question is from Rob, and he asked about warning messages that a broker sends. He said, I get the warning message that the limit price entered is below the market bid. Please verify the order before placing the order. He wants to know, should I change the limit price or leave it alone? Now this goes hand in hand with what we just talked about, using limit orders or using a market order. And I just said that limit orders are the way to go. So in this case, you put in that limit order, and it was basically the exact same scenario. We put in the limit order at $2. The bid's at $2.10. So the bid is currently saying that the price is not where our limit order is. We want to pay up to $2. They're letting us know that it's not going to get filled. The price is above that. Or, and it depends on if they're buying or selling, but let's say that we wanted to sell this contract, and when you sell it, you're saying that you want to pay above $2. So if we want to sell it for $2 and it's trading at $2.10 to $2.40, the bid and the ask, well, if we put in the $2 limit order, it's going to be treated as a market order because the bid's already above where our limit price is. And that's what sometimes you'll get a warnings for this. And this warning, not exactly sure if we're talking about buying or selling here, But either way, it's important just to understand the dynamic, because your broker's got all sorts of warnings that pop up to the point that you almost get tired of just clicking out these X's, especially when you're using limit orders, or if you're setting them farther away because you want to have an order in there to get filled once you hit a 50% gain, or you want to buy this option once it drops another 20%. So you get all these little red flags that pop up, and at some point it just comes to where you're just clicking the X, just trying to get rid of them, submit my order. And if that ends up being the case, you can make a big mistake, because a lot of those warning signs are important. So I love it when they send in these questions and they want us to take a look at and just make sure they're doing the right thing, because sometimes maybe the warning sign is saying that it's taking up too much of your account, and then you close it out, and then all of a sudden you have one options contract that's taking up 90% of your account, which is something you do not want. With options, we know that they're extremely volatile, and we're going to see big wild swings. They're going to help us generate massive profits, but we can't rely all on just one trade. We want to spread it out into as many options trades as possible. So we're going to stick to our limit orders, and that's in either case, whether we want to sell or we're trying to buy this stock. We want to pick our price, take a look at where the market is, understand what you're trying to do. If you're buying, then you want to pay the lowest price possible. If you're selling, you want to get the highest price possible. So keep those two things in mind when you go to place an order, and be sure to read those warning signs that come up. And if you have any questions, just send them our way and we'll be sure to take a look at those. Now, our next question, it just wouldn't be complete to have an options video mailbag without talking about margin. I get this question all the time. What is margin? And I think the biggest thing to point out with margin is that there's two different types of margin accounts. And when you say margin, it just has an overall negative sentiment to it. You don't want to touch margin accounts. You don't want to mess with margin, because that's where people mess up, right? They get margin calls, they're over leveraged, and they can blow up their account. But when it comes to a stock margin account, that's more common than an options margin account. And just to explain the difference, in a stock margin account, you're borrowing money to buy stock. And when you borrow the money, you're paying interest on the money. So that's one thing that I don't like about it. You clearly don't have the funds, and you're paying interest on that money just to borrow it and buy more of some stock. And then once you start to lose money on the stock that you're flooding and over leveraging your account into, then you get the margin call where your broker says, hey, you got to deposit more funds into your account or liquidate. And at that point, then you have the massive sell-offs where you're just having to liquidate everything in your portfolio just to try to get some cash back. And when you're having to sell at any price possible, that's a bad sign. So that's definitely something you want to avoid. I never recommend a stock margin account where you would be trading stocks in it. An options margin account is different. A lot of brokers require you to have this just to trade spreads and straddles and iron condors and such. Or the most common scenario is where you have an options margin account to sell put options on margin. Now in this case, when you sell a put option, you're basically saying that you want to buy this stock, 100 shares per one contract of whatever stock it is. So if it's a $50 stock, that would be $5,000 that you'd be looking to buy into this company. But let's say that if you could do that on margin, now your broker doesn't charge you anything. They tie up about 20% of that. So instead of $5,000 for one contract, they tie up $1,000. The premium that you collect stays the same. So you collect no matter whether you use margin or not margin, you're still collecting the same kind of premium that you would have regardless. But that extra $4,000 can basically just stay floating around in your brokerage account. You can have it invested in any other stock and different options trades, wherever you want. It's your money that you get to keep until you have to buy the stock. And then your broker will let you know, usually in the last week, that you need to come up with funds just to buy the stock. And it's something that you should keep an eye on too. I never recommend leaving stuff like that up to your broker, because you could still get in trouble if you over leverage your account. But if you're only selling put options occasionally to collect income from stocks that you really want to own, then I see nothing wrong with using a margin account, keeping the rest of the money moving already in your brokerage account and other stocks and other areas that you can liquidate, because it's your money. Why would you not be able to go ahead and do whatever you want with it, since their broker has no reason to tie it up other than a safety precaution? You don't get charged interest, there's no penalties, no fees, nothing like that. It just literally has to sit in your account when you don't use margin. So using margin in that case is okay. In an options margin account, just keep in mind, totally different than a stock margin account. So that's something that I always love to bring up when we talk about options. Now our last question today comes from John, and he's a big fan of Tesla. He said, I would like to own Tesla for the long term because I believe in the company and in Elon Musk. Should I be selling a lot of puts on Tesla, thereby either profiting from the premiums or end up being assigned the stock for a reduced price? And I love this question because this is exactly what we do in my pure income service. We just sell put options on stocks that we love to own. Stocks like Tesla and other giant stocks or little known stocks that are interesting companies that are doing great things that we really just want to own and have exposure to. And instead of buying them outright today, what we do is we sell put options. The whole service, pure income, is just about creating income. And we do it on great companies by selling put options. And in this case, John's looking to do it on his own. He loves Tesla. He's looking at this company and he wants to know if something like selling put options on a stock is a great opportunity. And as long as you have the cash to do it, because Tesla still, even after the price splits, they're still a pretty expensive stock. And it's going to keep in mind that one contract represents 100 shares of Tesla. So once you start selling just a couple contracts on a stock, you're talking about a nice chunk of change here that you're going to have to commit to Tesla. So just keep that in mind. You don't, even a great company like Tesla, I don't recommend putting all your chips in one basket to where you just have nothing but Tesla in your portfolio. But I love the idea of adding exposure to it by selling put options, and just do it staggered. Start with, a few months out, sell put options where you're collecting income from that month at one strike price, and then change the strike price almost to where it's like you're buying as it pulls back, right? 10% below here, you're collecting some income, and if it falls that far, you're willing to buy 100 shares of the stock. And then you go 20% below, you collect a little bit of income today, and if it falls that far, then you're willing to buy the stock again. You're willing to buy another 100 shares basically. And you kind of stagger it up and set it up like this, and even different expiration months. So that way you're just creating an income stream from a stock that you already want to own. And just make sure that you don't go overboard though with the contracts, because it can happen quickly where you're trying to collect more income, and then all of a sudden you're going to own $50,000 in Tesla and you have a $60,000 account. So just stuff like that, try to avoid it. As long as you know what you're doing, John, then I say go for it. Just do it small, collect some income, and continue to have exposure to the great company that you like Tesla. So that's all for my video today. I just want to say thanks for tuning in, and thanks for joining us here with the Weekly Options Corner. You can look forward to in the coming weeks to take a deeper dive into options concepts, and hopefully we'll be able to walk through a trade in the next week or two that's in real time that you can actually take advantage of that day that we send this out. So until next time, I'm Chad Shoup.